Right. So get this. Today we're looking at dividend stocks, the ones that maybe the market's overlooking a little.
Yeah.
The kind that give you a piece of some big name brands and some nice passive income on the side.
Sounds good.
We're basing our deep dive today on this article I found. It highlights 3 dividend stocks that it calls, quote, on sale.
Okay.
They are Vici Properties, Coca-Cola, and Hormel Foods. So what do you think?
Well, the interesting thing about these 3 is they each have different, risks and rewards.
Yeah.
So different profiles, which I think will be really interesting to unpack.
For sure.
It's almost like if you're picking cars, you got your reliable workhorse, you got your flashy sports car, and then you got your fixer-upper with potential,
Yeah, that's a great analogy.
Yeah.
So let's start with maybe the most unusual of the bunch, Vici Properties. I mean, casinos aren't exactly, the first thing you think of when you think stable income,
Yeah.
are they?
Right. Yeah, you wouldn't think so, but Vici Properties, they work on this triple net lease model, which means they own the properties, but the tenants, the casino operators in this case, right, they're responsible for like most of the operating costs. Vici just kind of, collects the rent.
Oh, okay. That makes sense. But then how did they, not just survive, but actually do well during the pandemic when casinos were basically shut down? The article even mentioned that they increased their dividend during that time.
Well, they've got a secret weapon, and that is incredibly long-term leases
Oh, wow.
with an average remaining term of over 40 years.
Wow. That's incredible.
And this is where it gets really interesting, right? Most of those leases, they actually include rent increases that are tied to inflation.
Oh.
So it's built-in protection. And you see, in REIT investing, a key metric is the cap rate, which is essentially a measure of the rate of return. And Vici's cap rate, because of those long-term leases and that inflation protection, it remains very attractive.
So for someone looking for like a steady high-yield income stream, Vici's 5.8% yield, it's tempting, right?
Yeah.
But you mentioned risk earlier.
Yeah.
What are the potential downsides? What are we missing here?
Well, the main risk with Vici is concentration.
Okay.
Their portfolio, it's heavily focused on the casino industry.
Makes sense.
If that sector struggles, it's going to hit their bottom line, for sure. So it's really, really important to think about your own risk tolerance and whether that concentration level works for you, whether it aligns with your investment strategy.
Right. It's not just about, chasing the highest yield. It's about understanding the business and, like you said, the potential vulnerabilities.
Yeah.
All right. Let's switch gears now to a company everyone knows, right? Coca-Cola. I know they pay dividends, but the article called them a Dividend King. What's so special about that?
So Dividend King is a title that is only given to companies that have increased their dividend payments every single year
Wow.
for at least 50 consecutive years. And get this, Coca-Cola, they've been doing this for 62 years.
62 years? That's insane.
It's amazing. It really shows incredible stability and a real commitment to giving back to the shareholders.
62 years. That's like, that's just incredible staying power. But with a track record that long, is there even any room for growth left? The article mentioned that Coca-Cola might even be undervalued right now. How is that possible?
So it all comes down to the valuation, how the company's currently valued.
Okay.
2 key ratios investors look at are price to sales, which is basically comparing the stock price to their revenue.
Right.
And then you got price to earnings, which compares the stock price to their profit. Right now, Coca-Cola's ratios are kind of hinting that maybe the market is underestimating their future potential, so it might be a good buy,
So even a giant like Coca-Cola can be a bargain.
Wow.
Wow. You really do learn something new every day. Their current yield is 3.1%, which, all right, not as high as Vici, but it's still pretty decent, right?
Exactly. And remember, you're not just buying a dividend, right?
Right.
You're getting a piece of this globally known brand with a ton of different products.
Yeah.
But, some investors are a little worried about the long-term prospects of sugary drinks in general these days. Do you think that's a valid concern?
It's a good question. What do you think? Is Coca-Cola adapting to, those changing tastes, those people who want healthier options?
Well, they're definitely aware of it.
Yeah.
And they've been working on diversifying, what they offer. Think about their bottled water brands, their teas. They even have coffee now. Plus, they've got this huge global reach, and their distribution network is massive. So that gives them, pretty big advantage.
Okay, so we've got the stable casino landlord. We've got the beverage giant. Now let's talk about the final company on our list, It's
Yeah.
another Dividend King, Hormel Foods.
Hmm.
They seem to be going through some rough times, and the article calls this a potential turnaround play. What does that actually mean?
Yeah, a turnaround play. It's basically when you have a company that, yeah, they're underperforming right now. Yeah.
But they have the potential to bounce back,
Ah,
to thrive again.
okay.
Hormel is facing quite a few challenges right now. Like, they're having trouble raising prices to keep up with inflation.
Yeah.
Their business in China, it's not recovering as fast as they hoped, and the avian flu has been affecting their poultry supplies.
Oh, wow.
And then, they recently acquired the Planters brand, and that's hit a few snags.
Wow, that's a lot to handle. The article mentions a historically high yield of 3.6%, which I guess that makes sense given all these challenges, right?
Yeah.
But is it a real bargain, or should investors be, a little worried?
That's the big question, isn't it?
Yeah.
To really assess a turnaround play, you got to look beyond the current struggles.
Yeah.
You have to analyze if the company's got what it takes to overcome them. With Hormel, we really need to dig into how serious each challenge is and what their plan is to fix things. Okay, well, let's unpack that a little, right? Let's start with inflation and pricing. How big of a concern is that for Hormel, do you think? Is it just, something temporary, or is this, is it a deeper, more structural problem?
Well, you got to remember the whole food industry is dealing with rising costs right now.
Yeah, that's true.
So it's not just a Hormel thing. However, their ability to actually pass on those costs to us, the consumers, is really important.
Yeah, I mean, we all see it when we go to the grocery store.
Exactly.
The prices are just going up.
Yeah.
But they can't just keep raising prices forever, can they? I mean, eventually people are going to start cutting back or switching to cheaper brands, right?
Exactly. That's why their pricing power is so important to look at. Do they have those big brands that people are willing to pay more for?
Yeah.
Or are they mainly competing on price? That's what we need to dig into.
Right.
A little deeper.
Okay, so when we talk about this pricing power, what are we really getting at? I mean, is it just about having a well-known brand? That's it.
It's a bit more than that. Having a strong brand, yeah, it definitely helps.
All right.
But real pricing power, it comes from offering products that that consumers, they see as unique or essential, even if it costs a bit more,
Okay.
Like think about Spam. It's almost like a cult classic now.
Yeah, that's true. Spam does have it has its fans, that's for sure. And they've even they've made it trendy again. You see all these like gourmet Spam recipes online now. It's pretty wild. But what about their other products? Do those have that same staying power?
Well, that's where their history of innovation comes in. Hormel has, they've consistently gone beyond just canned meats. They've moved into snack packs, natural and organic options, and even plant-based stuff. They're trying to adapt to those changing tastes we were talking about.
Right. So it's not just about having a beloved product like Spam. It's about having like a pipeline of new products to keep people interested, keep them coming back. But let's get back to those headwinds for a second. What about their struggles in China? The article mentioned a slow recovery there. How much does that actually affect Hormel's overall business?
Well, China's a huge market for a lot of food companies, and Hormel's, no different. They've put a lot of resources into building up their presence over there. So a slow recovery, it definitely it throws off their growth projections.
Makes you wonder if their timing was just bad. Like did they expand into China right before consumer spending started to slow down?
Yeah, that's possible, but it's also important to think about the bigger picture. The economic and geopolitical factors that are at play. The Chinese market, it's complex, and companies need to be they got to be ready for things to change quickly.
For sure. Okay, so we've got inflation, we've got China. Those are big question marks. But what about this avian flu situation? How much does that hurt their poultry business? How bad is it?
The avian flu has been a pretty big disruption, to the whole poultry industry globally.
Yeah.
So yeah, it's definitely affected Hormel's supply chain and driven up their costs. But it's important to remember that this is probably a temporary thing.
You're right. The avian flu is not going to be around forever. But these problems, they're kind of piling up on Hormel. Right. And then you add in the Planters acquisition, which the article called a headache. Did Hormel, did they bite off more than they could chew with that one?
Acquisitions are always tricky. On paper, Planters seemed like a good fit. I mean, it's a popular snack brand. It's got it's in a lot of stores already.
Right. Makes sense.
But trying to combine a new brand into an existing company with its own culture and, ways of doing things, it can be a real challenge.
Yeah.
It's almost like trying to merge two families with different traditions and personalities. It takes time for everyone to adjust. And in this case, it seems like maybe those benefits they were hoping for, those synergies, they haven't happened as quickly as Hormel thought. They've run into some unexpected costs and some problems with distribution.
Okay, so let's recap, right? We've got inflation squeezing their profits. We've got a slow recovery in China. We've got the avian flu messing with their supplies. And we've got an acquisition that's not going as planned. It's a lot to overcome. But the article still says Hormel's a potential turnaround play. What makes them think that? What's the potential here?
Well, even with all those challenges, Hormel's got a few things going for them.
Okay.
First, they've got a long history of innovating. They've shown they can adapt to changing consumer tastes and come up with new products that people like.
We talked about that earlier. They're not just the Spam company. They've got Skippy peanut butter, Jennie-O turkey. They've got a wide range of products.
Exactly, and that diverse portfolio, it helps them deal with problems in specific categories. And second, they have a strong balance sheet. They're not,
Right.
drowning in debt, and that gives them some flexibility, some breathing room to work through these challenges.
Okay, so they've got the track record of innovation, and they've got the financial stability to potentially turn things around. But what should investors be? What should they be looking for to see if this turnaround's actually happening? What are the key signs of success?
Here's what I'd be keeping an eye on. First, can they get better at pricing?
Okay.
Can they offset those inflationary pressures? Second, are they making progress in China?
Right.
Or are those problems sticking around? Third, what about the Planters integration?
Yeah.
Are they making things more efficient? Are they getting those cost savings they were hoping for? And lastly, are they still innovating?
Okay.
Are they bringing out new products that people actually that people want to buy?
Those are all great points. So it's not just about looking at their past; it's about understanding their strategy for the future, and if they're actually making it happen. So to wrap up our deep dive into these three very different dividend stocks, what's the main takeaway here? What's the big picture for our listeners?
I think the biggest takeaway is this. Investing, especially when it comes to dividend stocks, it's not just about chasing yield.
Right.
It's about understanding the business, its strengths, its weaknesses, and its potential to grow in the future. Each of these companies, they've got their own risk and reward profile, and it's up to each investor to decide which one, if any, fits their goals and their risk tolerance.
That's a really important point. There's no one right answer.
No.
You got to do your research. You got to understand the companies and then make decisions that work for you. But that's what makes investing so interesting, right? It's always a learning process, and there's always something new to discover. It's like we've done a deep dive into three different personalities, each with its own quirks and potential.
Yeah, that's a good way to put it. And just like getting to know a person and understanding a company takes time. You got to pay attention,
Speaking of paying attention, I'm curious. What are some red flags that investors should watch out for when they're looking at dividend stocks? What are the warning signs that maybe a company isn't as healthy as it seems?
Oh, that's a really important question. One red flag is a dividend payout ratio that's too high, unsustainable.
Right.
It means the company's paying out a huge chunk of its earnings as dividends, and that doesn't leave much left over to reinvest in the business or to handle, unexpected problems.
So it's like someone living paycheck to paycheck, basically.
Yeah, pretty much. No savings to fall back on.
What else? What else should we be wary of?
Another warning sign is when the dividend growth rate starts going down.
Okay.
If a company has been steadily increasing its dividend at a healthy pace, and then suddenly it slows down a lot, that could be a sign of trouble.
It's like that friend who always throws these huge parties.
Yeah.
And then suddenly they start cutting back. You got to wonder if they're having money problems, right?
Exactly. You got to look for those subtle changes, the ones that might tell you something's going on behind the scenes.
So we've talked about the risks, the red flags, and the importance of doing your research, but let's bring it back to our listener for a minute. What's the one piece of advice you'd give someone who's interested in dividend investing, but maybe they're feeling a little overwhelmed by all this information?
If I could give just one piece of advice, it would be this. Start small and diversify. You don't need to invest in all three of these companies or even, just in dividend stocks. Pick one that you feel good about, one that fits your risk tolerance and your goals, and then slowly build your portfolio from there.
That's great advice. It's like, dipping your toes in the pool before you jump in head first.
Right.
Gives you a chance to get comfortable and make changes as you go.
And remember, investing is a marathon, not a sprint.
Yeah.
You got to be patient. You got to be consistent.
This deep dive has been it's been really insightful. We've explored these three fascinating companies, and each one has given us a different perspective on dividend investing. What's the final thought you'd like to leave our listeners with today? The big takeaway.
Here's something to think about. The market, it's always changing. What looks like a bargain today, it might not be a bargain tomorrow. So stay curious, keep learning, and never be afraid to question what you think you know.
That's some great advice.
Yeah,
thanks for joining me on this deep dive. It's been fun exploring the world of dividend stocks with you. And to our listeners, remember, knowledge is power. The more you know as an investor, the better you'll be able to navigate the market and reach your goals. Until next time, happy investing.
Yeah, it's like we got to know three different personalities with their own, strengths and weaknesses and potential. You've got Vici, the steady long game player, Coca-Cola, the reliable powerhouse, and then Hormel, the innovator, going through a bit of an identity crisis, maybe.
Yeah, I like that. That's a good way to think about it. And just like getting to know a person, it takes time. Got to pay attention, observe.
Speaking of observation, I'm curious, are there any red flags that investors should look out for when they're evaluating dividend stocks? Any warning signs that maybe a company isn't as healthy as it looks at first glance? That's a great question. One thing to watch out for is the dividend payout ratio. If it's really high, like unsustainably high, that could be a red flag.
Okay.
It means the company is paying out a huge chunk of its earnings as dividends, which doesn't leave a lot of room for, reinvestment or to deal with unexpected problems.
So it's like they're living paycheck to paycheck, basically.
Pretty much, yeah. No savings to fall back on.
What else should we be careful about? What other warning signs?
Another one is a declining dividend growth rate. If the company has been consistently raising its dividend at a good pace, and then all of a sudden that growth slows down, well, that could be a sign that something's not right.
It's like that friend who always throws these lavish parties, right? And then suddenly they start cutting back. You got to wonder what's going on. Are they having money troubles?
Exactly. You got to pay attention to those subtle changes. They might be telling you something about the company's its underlying financials.
So we talked about the risks, the red flags, and why it's so important to do your research. But let's think about our listeners for a second. What's the one piece of advice you would give to someone who's interested in dividend investing, but maybe feeling a little overwhelmed by all the information, all the things they got to consider?
If I had to give just one piece of advice, it would be this. Start small and diversify. You don't have to invest in all three of these companies right away, or even just in dividend stocks at all. Just pick one that you feel good about, that aligns with your risk tolerance and your goals, and then go from there. Build your portfolio slowly over time.
That's great advice. It's like dipping your toes in the pool before you jump in head first.
Right, exactly.
You can test the waters, get comfortable, and make adjustments along the way.
And remember, investing is a marathon, not a sprint.
Yeah.
It's about patience and consistency.
Well, this deep dive has been really insightful. We got to explore these three companies, and each one has given us a unique perspective on dividend investing. What's the final thought, the big takeaway you want to leave our listeners with today?
Here's something to think about. The market is always changing. What seems like a good deal today might not be so great tomorrow. So stay curious, keep learning, and don't be afraid to question your assumptions.
That's great advice. Thanks for joining me on this deep dive. It's been a pleasure exploring the world of dividend stocks with you. And to our listeners, remember, Knowledge is power. The more you know, the better you'll be able to navigate the market and achieve your goals. Until next time, happy investing.